Hey everyone, and welcome back. Today, we're going to be looking into something pretty important for, well, anyone who's into crypto. Whether you've been trading for years or just starting out, we're going deep into the hidden mechanics of the crypto market, really trying to uncover how things like liquidity and market control are actually influencing those price charts we're all glued to. Like, have you ever wondered how a small buy order can suddenly send a coin's price through the roof? That's what we're here to break down.
Yeah, the idea of decentralization is like this huge thing in the crypto world, but the truth is often a lot more complicated. So what we're going to be exploring today are those factors that really impact liquidity and control. And we're going to be talking about everything from the influence of whales, basically those individuals or institutions holding massive amounts of crypto, all the way to the role of exchanges themselves. Get ready for some surprising stuff. Even I was raising an eyebrow in some of the findings in this research.
Okay, I'll admit the idea of whales secretly controlling things is a little unnerving, even if it's unintentional. I'm super curious to hear how that all works. It sounds like we're about to expose some of the secrets of the crypto market.
Right. So let's start with the basics. Every time someone buys or sells cryptocurrency, it impacts the market's liquidity. You can think of liquidity as how easily you can buy or sell something without causing major price swings. Now, when a whale makes a trade, especially a large trade, they're essentially shifting a ton of water in that liquidity pool, and it causes ripples that everyone else feels. It might not always be intentional manipulation, but the impact is undeniable.
So let me get this straight. Are you saying that even if these whales aren't deliberately trying to manipulate the market, their size alone means they can't help but influence things?
Yeah.
Exactly. It's like, let's take Bitcoin as an example.
Hmm.
It's often held up as this perfect example of decentralization. But in reality, a significant portion of all Bitcoin in circulation is actually held by a relatively small number of addresses. So imagine just one of those holders decides to sell a big chunk of their Bitcoin. That sudden flood of sell orders could trigger a cascade, pushing the price down as others panic and start selling too.
Wow, that's a pretty powerful example. It really makes you question that whole decentralized idea.
It does. And this concentration of ownership, it's not just a Bitcoin thing. We see it across a lot of digital assets, even with stablecoins.
Oh yeah, speaking of stablecoins, I'm curious about how they fit into all of this. I mean, they're designed to be stable, right? So how they get caught up in all this talk about whales and liquidity? That's a really good question, and it kind of gets to the heart of how interconnected the whole crypto ecosystem really is. While stablecoins are supposed to offer stability, because they're pegged to a more stable asset, like the US dollar, for example, they're still subject to the same liquidity dynamics as other cryptocurrencies. And most stablecoins are actually issued and managed by these centralized organizations.
Okay, so then how does that centralized control contribute to this manipulation we've been talking about? Doesn't that seem kind of contradictory to the whole decentralization thing?
It definitely is. Let's take Tether, USDT, as an example. It's one of the most popular stablecoins out there. And even though it's supposed to be pegged to the US dollar, the entity controlling Tether has the power to issue more USDT, or even reduce its supply. And that control over supply directly impacts its liquidity, which as a result can ripple throughout the whole market.
Wait, so you mean to tell me that just one single entity controlling a stablecoin could actually set off a liquidity crisis across the entire crypto market? That sounds a little apocalyptic, don't you think?
But it's definitely something to consider. Imagine if for whatever reason, there was a sudden and big contraction in the supply of a major stablecoin like Tether. The squeeze on liquidity that would come from that could send shockwaves through the whole crypto world, potentially leading to a domino effect of, you know, price drops and panic selling.
Okay, that's a scary thought. But you know what they say? Knowledge is power. So let's dive into the nitty-gritty. What are some of the specific tactics that these whales or big players use to manipulate the market?
Well, one of the most well-known and I'd say oldest tricks is the pump and dump scheme.
Yeah, I've heard of that. It's not exactly a new thing. Didn't that used to happen a lot in the stock market?
You bet. But it's found a whole new life in crypto. It basically works like this. A group gets together and coordinates to aggressively buy a particular cryptocurrency. They basically create this artificial hype. As the price goes up, other investors who don't suspect anything, they get caught up in the FOMO, that fear of missing out, and jump in, thinking they've just found the next big winner.
And then they all pile in, driving the price even higher, right? So what happens next?
And then as soon as the price peaks, the people who orchestrate the whole thing, they dump their holdings and pocket huge profits, leaving everyone else holding an asset that's rapidly losing value. It's like the classic bait and switch. playing on people's greed and their desire to get rich quick.
Man, that's just sneaky. It sounds like something straight out of a movie about Wall Street, but with a crypto twist. So are there any other tactics they use?
Oh yeah, for sure. And it's not always about inflating prices either. There's also something called a bear trap, which plays on fear during a market downturn.
Okay, now I'm really intrigued. So tell me, how does this bear trap thing work?
So picture this. The market's already heading down, everyone's on edge. And then suddenly, a group of manipulators floods the market with sell orders. They basically create a mini panic. Smaller investors who are already nervous, they see the price plummeting and rush to sell their holdings to try to avoid losing even more.
So it's like they're creating a self-fulfilling prophecy of fear, making the price drop even more because everyone's so scared they just start selling.
Exactly. And you know who benefits from all that panic selling? The manipulators themselves. They get to buy up those assets at a huge discount and then just wait for the market to recover. It's a pretty ruthless tactic, but unfortunately it works way too well.
This is all starting to sound like a psychological thriller or something, but we're not done yet, are we? What about all those high-frequency trading bots I always hear about? Don't they play a role in all of this too?
Absolutely they do. And they add like this whole other layer of complexity to this, like this already super intricate web of market manipulation. But we'll get into their tactics and the challenges they bring in the next part of our deep dive.
Can't wait. I'm already hooked. This is some seriously eye-opening stuff. Okay, so let's talk more about those high-frequency trading bots. They're like this mysterious secret weapon
Yeah.
used by like Wall Street wizards or something. I'm ready to finally understand how it all works.
Well, they're definitely powerful tools, that's for sure. And not always used for good. You see, these bots are designed to execute trades super fast, way faster than any human trader could. We're talking milliseconds here, where they can, analyze market data, identify patterns, and make split-second decisions.
Okay, yeah, that makes sense. I can see how speed would be a big advantage in the crypto market, but how exactly are they used for manipulation? It seems like they would be great for like making smart trades.
Well, they can be, but it all depends on who's controlling them. Let's look at some of the tactics they use for manipulation. One common technique is called spoofing. So imagine a bot places a large buy order for a cryptocurrency.
So it's like creating this illusion of strong demand and the price starts to go up, kind of like creating artificial hype. Big hype.
Exactly. But here's the thing. That big buy order is never meant to actually go through. It's just a decoy, like a fake signal. And then as the price climbs and real buyers start to get FOMO and jump in, the bot cancels the original order and places a sell order at that inflated price.
Wow, that's so sneaky. So they create a fake wave of demand, trick people into buying at a higher price, and then cash out before anyone even realizes what's happening.
Exactly. And these bots work so fast,
Mm-hmm.
it's practically impossible for a regular trader to even realize what's going on, let alone react in time. It's like trying to play chess against a supercomputer, you know?
Man, this makes me feel kind of helpless as an average crypto investor. Like the odds are stacked against us. How are we supposed to compete in a market where these bots are calling the shots?
It's a valid concern, for sure,
Mm.
but are things you can do to level the playing field, even if you don't have access to those super fast algorithms. The key is to focus on what you can control, like your knowledge, your strategy, and your risk management.
Okay, I like that. So break it down for me. What kind of knowledge do we need to arm ourselves with?
For starters, you got to understand how these bots work. The more you know about their tactics, the better you'll be at spotting manipulation. Start by digging into the mechanics of high-frequency trading. Learn about order types, market depth, and how bots analyze and exploit even tiny price differences.
So it's like learning to speak the enemy's language. If we understand their moves, we can start to anticipate them.
Right. And it's not just about the bots themselves. It's about understanding the bigger picture of market manipulation. Remember we talked about earlier with whales and pump and dump schemes and bear traps. It's all connected.
Yeah, it's like they're all tools that can be used to move the market, sometimes for legit reasons, I guess, but often for, well, not so ethical reasons. It makes me realize how important it is to be skeptical, like not just believing everything you see at face value, especially in the crypto world where there's so much hype and speculation.
Absolutely. Skepticism and research go hand in hand. Before you even think about investing in any cryptocurrency, do your homework. Go beyond those flashy headlines and social media hype.
So don't just trust what some crypto influencer is saying on Twitter.
Yeah, exactly. You got to dig deeper. You need to understand the fundamentals of the project, the team behind it, the tech, the actual real-world use case. The more you know, the less likely you are to fall for some manipulation scheme.
That makes sense. But where do you even start looking for reliable info? It feels like there's so much noise out there. How do you separate the real stuff from the fake stuff?
Yeah, it's definitely a challenge. That's why it's important to look at a bunch of different sources. Check out reputable news outlets, industry publications, research reports, and don't forget about those community forums and online discussions. You can often find some really good insights from experienced traders and analysts there. A lot of them are willing to share what they know.
Right, because sometimes the best advice comes from people who have actually been through it. So we talked about knowledge. But what about strategy and risk management? How do we use what we've learned to make smarter trading decisions?
One of the biggest things to remember is you're not racing against the bots. You don't have to try to be smarter or faster than them.
So we can't beat them at their own game.
Probably not. Instead, focus on developing a trading strategy that aligns with your own goals and your risk tolerance. Figure out if you're a short-term trader looking for quick wins, or a long-term investor with a hold strategy.
Okay, so know yourself and your goals. What about risk management?
That's super important. Remember, crypto is volatile even without all the manipulation. Never invest more than you can afford to lose. And use tools like stop-loss orders to limit your potential losses. A stop-loss will automatically sell your crypto if the price falls below a certain point. It helps protect your capital.
It's like a safety net then, setting boundaries to keep yourself from getting swept up in those crazy market swings.
Exactly. Diversification is another key part of risk management. Don't put all your eggs in one basket. Spread your investments across different cryptocurrencies and asset classes. That way, if one investment doesn't do well, it won't wipe out your whole portfolio.
Right, it's like that saying, don't bet the farm on one horse.
Exactly. And when you're making trading decisions, don't just rely on technical analysis or chart patterns. Those can be manipulated too, by bots and whales.
So don't just follow the hype or the crowd.
Right. Always look at the bigger picture. What are the project's fundamentals? Is there a real use case? Is the team legit? Ask yourself those questions before making any decisions.
This all makes sense. It's about being informed, having a plan, and managing risk. But even if we do everything right, is there still a chance of getting caught up in some crazy manipulation scheme?
There's always some risk, especially with crypto being so unpredictable. But the more you understand about how things work, the better you'll be at navigating those risks.
Right, it's like having a map and compass in uncharted territory. You might not know every twist and turn, but you'll at least be able to find your way. This has been really eye-opening. I'm definitely looking at the crypto market differently now.
And there's still more to explore. In the next part of our deep dive, we'll talk about the role of exchanges, the growing influence of institutional investors, and what the future might hold for this crazy, fast-evolving ecosystem. Stay tuned.
Okay, so we've talked about whales and bots and all these manipulation tactics, but what about the platforms where all this trading actually happens? What about the exchanges? What role do they play in all this?
Yeah, they're way more than just neutral platforms, just connecting buyers and sellers. Exchanges really hold a lot of power in the crypto world. They control things like the order books and the trading fees. And probably most importantly, they manage the liquidity pools for leveraged trading.
Ah, yes, leverage trading. That's where things can get really risky, right? It's when traders basically borrow funds, so they can amplify their potential profits, but also their potential losses.
Exactly. And that's where the conflict of interest comes in. You see, exchanges actually make money from liquidations. When a trader's leveraged position gets blown up, because the market moves against them, their assets get sold off to cover the debt. And guess who collects fees on those forced liquidations? The exchanges.
Hold on a sec. So you're telling me that exchanges actually benefit when traders lose money? That doesn't sound right. Wouldn't it be better for them in the long run if the market was more stable, so fewer people got liquidated?
Yeah, that's a good point. And it kind of highlights the ethical issues that we're seeing in the crypto world right now. I mean, in theory, yeah, a stable market would probably attract more long-term investors and create a healthier ecosystem overall. But the reality is that volatility drives trading volume. And trading volume means fees for the exchanges. It's a tough situation for sure.
Yeah, it sounds like the incentives aren't really aligned, so what can we do to fix this conflict of interest?
That's the big question. And there's no easy answer. But I think increased transparency would be a good start. Like, what if exchanges had to publicly show their liquidation data? So everyone could see how much they were profiting from these events. Having that extra layer of accountability could help prevent some of those shadier practices.
Transparency is always a good thing, like shining a light on what's happening behind the scenes.
Exactly. It makes it harder for people to hide what they're doing.
What else can we do to make things more fair for everyone?
Well, decentralized exchanges, or DXs, could be a solution. The idea is to get rid of the middleman, so users have more control over their own funds, and it eliminates those centralized points of control that could be exploited.
So with DXs, it's more like peer-to-peer trading them, like
Yeah.
cutting out the middleman and connecting buyers and sellers directly.
Exactly. DX is run on blockchain technology, so transactions are trustless and transparent. They're still pretty new, and sometimes liquidity can be an issue, but they represent a big step toward a more decentralized and fair trading environment.
That makes me think about the whole issue of regulation in the crypto world. Can regulators even keep up with how fast things are moving and changing?
It's a huge challenge for regulators all over the world. You know, those traditional financial regulations, they were made for a different time. For centralized institutions and well-established markets, crypto is totally changing the game, and regulators are struggling to catch up.
Sounds like we need a whole new set of rules for this space.
Absolutely. We need regulations that encourage innovation, but also protect investors and make sure the market is fair. It's a delicate balancing act, and it's going to take cooperation between policymakers, industry leaders, and the crypto community itself.
It can't just be a top-down approach. One of the best things about crypto is that it's grassroots. It empowers individuals. But with that power comes responsibility, right?
Right. Self-regulation and community-driven efforts are so important for building a sustainable and trustworthy ecosystem. Think about things like code audits, bug bounty programs, and open source development. Those can help identify weaknesses and prevent exploits before they even happen.
So it's like the crypto community policing itself from within. That's pretty cool. But let's be real for a sec. There will always be people trying to game the system, right?
Unfortunately, yeah, that's probably true. As long as there's money to be made, there will be people trying to take advantage of others. That's why it's so important for individual investors to stay informed, be vigilant, and approach the crypto market with a healthy dose of skepticism.
Skepticism and a thirst for knowledge, those seem to be the key takeaways today.
You got it. Don't believe the hype. Do your research, understand the risks, and never forget that there are no guaranteed returns in crypto. It's a high-risk, high-reward game.
So with everything we've talked about today, where do you see the crypto market going in the next few years?
Well, predicting the future is always a gamble, especially in a market as volatile as crypto. But I do think the next few years are going to be crucial for the whole industry. We'll probably see more institutional adoption, further integration with traditional finance, and continued innovation in areas like DeFi.
So a lot of growth and change, but also a lot of uncertainty.
Exactly. It's
Yeah.
going to be a wild ride. But it's also a really exciting time to be a part of this space. As the market matures and regulations catch up, we might actually see a more stable and transparent ecosystem emerge. But it's going to take collaboration, innovation, and most importantly, a commitment to those core values that started this whole movement. You know, decentralization, transparency, individual empowerment.
I like that. It reminds us that the future of crypto isn't set in stone. It's being shaped right now by the choices we make, the actions we take, and the conversations we have.
Exactly. So let's make good choices, act responsibly, and keep the conversation going. Thanks for joining us on this deep dive into the crazy world of cryptocurrency.
That's a wrap on today's deep dive, everyone. Stay curious, stay informed, and most importantly, stay safe out there in the wild world of crypto. Until next time, happy trading.